that right? Okay, I'm gonna go with yes. Thank you guys for being here today. And I know that when Christy had sent out the invite, we talked about doing flood insurance, but because FEMA is making lots of updates and changes that go into effect on October 1st, I'm going to have to completely redo that CE course. And I didn't want to go over all of that information. And then it changed and you'd be like, oh my gosh, I just learned all this. And now, you know, a lot of it is changing. So what I'd like to do is wait and do something separate that touches on all of the changes that FEMA has made to the flood insurance program. So today we are going to go over understanding different types of property insurance. And for those of you that I haven't met yet, I meant to do this when I started. My name is Sarah Dotson and I am with Prosper Insurance. And I do CE courses for your office on a monthly basis on the third Tuesday of every month. So thank you for being here this morning, Mary and Noelle. So we are going to get started on the different types of property insurance. And
Thank you.
oh, thanks. Oh, hi, Noelle. Good to see you. We'll go ahead and get started. And again, this is super informal. So if you want to chime in with any questions at any time, please feel free to stop me and ask the question, or you can put it in the chat as well. Like I said, super informal. And okay, so we'll get started. So first off, we're going to talk about condominium insurance. So as you can see on the screen, the responsibility for coverage on condo insurance is typically split between the condo association and the unit owners, resulting in 2 policies per unit. And so the unit owner would be the person who owns the condo and lives inside of it. So you have the master policy and the condo unit owners policy. So I'm going to touch on the master policy for a condo first. The master policy provides property damage and liability coverage for the residential condo building and its common areas. So examples include condo buildings, co-op buildings, and some home communities that have what are called single family condos. They're detached dwellings, but they're owned by an association, and the association has a master insurance policy on each separate dwelling. So still that unit owner would only need to get a condo insurance policy. And the external coverage of the condo or the dwelling includes roof and external walls. The common area coverage that I just touched on includes hallways, elevators, stairs, and recreational areas. And the amount of coverage provided varies from policy to policy, you know, depending on the condo size and type and everything that it offers. Examples of incidents that might be covered by the master policy in the common areas include, let's say, a fire breaks out into a party room. You know, a lot of like condos, like big condo buildings have like club or party rooms that the unit owners can rent out to host parties. So let's say a fire breaks out in one of those rooms that leads to injuries of the attendees of that party and causes property damage. So that would be an example of liability and property damage coverage. Let's say a tornado like comes through and knocks down like some storage units. That is a common area of the condo association, and it messes up those storage buildings that would fall under any type of incident by the master policy that would not fall on the unit owner, again, because it's a common area. Or let's say a bicycle is stolen from like a bike storage room because it's a common bike storage area, and that bike is stolen from the common area, that would fall under the master policy coverage and not the individual owner. So while it's clear who pays the premium for this policy, so it's the master policy, so the association pays the premium for this policy, it falls on the association. It can be a little less clear who pays the deductible in the event of property damage. In most cases, whoever pays for the deductible depends upon how the damage was caused and what exactly the damage was. So here are the most common outcomes. So you may be responsible for the entire deductible if the property damage only affects your unit, and if the property damage may have been your fault, like something you did that was you caused, then you may be asked to pay the entire deductible for the insurance claim. Likewise, if only some of the units were damaged, you may split the deductible among the affected parties. You may be responsible for only part of the deductible. If a common area of the property was damaged, such as like a pool, a garage, or an outdoor area, the deductible may be split among all unit owners. And this may also be the case if only some units are damaged, but the damage was not due to negligence. And then third is the condo association may also pay the deductible. So some condo associations will collect money for insurance deductibles as part of their regular fees, their condo fees that each unit owner pays each month. So they may collect money each month to like put aside to pay for any deductibles that they might have to in the event of a claim. And then others may have a slush fund that can be used to cover the cost of the deductible. So that's something that you would, if you are a condo unit owner, you would want to make sure that you ask the association if such a fund events or exists rather, so you know if the money you're putting into it each month is going towards any type of deductible. And then we move on to a condo unit owner's policy. So that was all about like the master policy that the association handles. Now we're going to talk about the individual condo unit owner policy. So the condo and owner's insurance policy provides coverage for the owner of the individual condo unit or townhouse, or if it's, like I said, a single family condo. They own the interior of the unit and therefore need coverage for the portion of the unit they are responsible for insuring. So the interior walls in, as well as any of their personal belongings that they bring into the condo, and liability protection. So the association has liability protection for the entire building. You need liability protection for your specific unit. So this type of policy is commonly referred to as an HO6, which is what a lender will require a buyer have in place at the time of closing. So this is where it comes, it's really important for you guys to know this, and it can impact you when you're working with a buyer that's purchasing a condo. Part of the, one of the pieces that they have to have in order to go to closing is insurance. The lender will require it, and they're going to require an HO6 policy. And then the coverage includes the unit itself, the walls, any fixtures, the personal property. So any item you bring into the home, liability coverage. So if someone is injured, in your unit, let's say that doesn't live in your home. So a guest you have coming to your home, let's say they slip and fall down some stairs, they could sue you for any type of medical expenses that they incur as a result of that injury from falling in your condo. So that's what the liability coverage is there for. Loss of use coverage. Loss of use means that, let's say you experience a fire in your condo and you are unable to live in that condo for like 30 days or 60 days due to it having to be repaired and renovated. And let's say you need to stay in a hotel for a certain period of time. You have coverage built into the policy that's known as loss of use, or sometimes additional living expenses, it will be referred to, that you can use to be reimbursed while staying in a hotel while your condo is being repaired and renovated. And then a condo policy also includes something that is called loss assessment. So loss assessment is, let's say that the condo association experiences a pretty big loss. Let's say a big storm rolls through and does damage to like all the roofs of like the roof of the condo building, and they have to replace the roof and they need to replace siding. And let's say it's just a really big claim, and they have to pay out a high deductible in order to pay for that claim. They can assess each condo unit owner, a certain amount of money to put towards that deductible. So let's say they're coming and assessing you all for $5,000. Well, you're like, well, I don't have $5,000 to give to the condo association to go towards this claim. What you have built into your condo policy is loss assessment coverage. So you can file a claim and get that money that the condo association is looking for you to provide to go towards this claim. And you would have to, I'm sure, show proof of the assessment from the association. It looks like I see something in the chat. Do we have a question? Oh, okay, I don't see anything. Okay. Any questions about this so far? No? Okay, great. All right, so how claims are handled between unit owners. So whether or not you and your insurance company can subrogate against another unit owner or the condo association depends on two things. One, your state law. So it depends on what the statutes are for the state. And then two, your condo declaration. So you can look in your condo documents, it should, or in the bylaws. And I've never lived in a condo, so I don't know exactly, the ins and outs of the condo documents, but I know that that would all be listed in those condo docs. So certain state laws and certain condo declarations require a mutual waiver of subrogation rights against another unit owner and the condo association. And then I talked about this briefly a few minutes ago regarding loss assessment. So loss assessment is an optional coverage for condo units owners, but highly, highly recommended, because as I stated, it covers situations in which the unit owners in a condo are financially responsible for a shared loss, so long as the issue was, a covered peril, such as like a storm, came through, or fire damage in the lobby of a condo building, etc. So loss assessment coverage will pay for whatever the individual share the unit owners must contribute to make up that difference. The minimum amount that you can add to a policy, I believe, is $5,000. but you can add up to, I think, like $10, $20, $25,000 as well. So if you want to have a little extra cushion, let's say they assess you $8,000, but you only have $5,000 of coverage. Well, where is that $3,000 going to come from? Your pocket. So it's always great to err on the side of caution and have it up a little, like up it a little bit. It really doesn't cost that much to up it on your policy. Any questions before we move on to condo flood insurance? So you're getting a little bit of flood in here today, just a hair, just a drop. Okay. So condominium flood insurances. So we'll talk about the differences between flood insurance on a single family home and on a condo building, the responsibilities of the association versus the unit owner, and then the coverage available to a unit owner. So FEMA created a special flood insurance policy for residential condo buildings. It's called the RCBAP. And that stands for Residential Condominium Building Association Policy. It's a mouthful. I'll say it again. Residential Condominium Building Association Policy. It covers the entire building under one policy. So one flood policy for the entire condo association, one deductible for the entire building, and provides replacement cost coverage along with higher limits. So if it's a single family home, FEMA only covers up to $250,000 of dwelling coverage, but with a condo, it's higher limits. And I'll get to that in a minute. And then coverage extends to the building itself, so the dwelling, the common areas. So if there's a lobby, a rec room, a storage unit, etc., it covers those common areas. And then the unit, which includes drywalls, cabinets, ceilings, fixtures, appliances, and flooring. So anything basically attached to the condo. So the BAP allows a condo association to purchase coverage for the up to $250,000 per unit. So per unit, but not exceeding the replacement cost. So a 2-unit condo can purchase a policy with up to a $500,000 dwelling limit. Because like I said, for one dwelling, it's $250,000. So with condos, they're allowing each condo to represent $250,000, but not go over the replacement cost. So a 10-unit condo, you can purchase up to $2.5 million. But if the replacement cost of this 10-unit condo is only $1.8 million, then you can only insure it for $1.8 million. So it's up to that, but not exceeding the replacement cost. And the replacement cost is determined by an insurance agent using what is called a replacement cost estimator, where it factors in the age, size, number of units, square footage, et cetera, et cetera. That's how the replacement cost is determined. And a lot of times the insurance company will want to see the replacement cost estimator to make sure that it's getting the appropriate amount of coverage. And a unit owner can purchase an individual flood policy that will provide coverage for the interior of the unit and their personal belongings. So that includes furniture, clothes, basically anything that isn't nailed down. So it's a really inexpensive policy that they can get to protect their belongings from any type of flood damage that they could experience. Any questions before we move on from that? Okay, great. All right, so now we're going to talk about 2-unit condo insurance and the importance of the association bylaws and identifying what type of insurance is correct for the situation, general liability requirement, and ramifications of insuring 2-unit condos incorrectly. So all condo owners associations establish rules or bylaws that govern the complex. The bylaws outline the requirements for condo association insurance, including specific requirements for the coverage. So the deductibles, the coverage limits, the type of coverage that the association must purchase. So that's all put into place in those bylaws. And that like lines out for them what type of insurance policy they need, how high the limits are, what the deductible is, what maybe it's a minimum deductible, or maybe they don't want it to exceed a certain amount. Because again, when you're moving like deductibles around, if you have a higher deductible, you're going to have a lower premium and vice versa. But the condo association might not want to be responsible for having like a $10,000 deductible, because they might not like have that, put away to pay for a claim. So they're going to go through and figure out what the stipulations are. And then from there, get the insurance policy. General liability covers for bodily injury or property damage arising out of the association's premises or operations, and every association needs this. You can get it like through a commercial policy, or sometimes just like, your normal insurance agent might be able to do it as well. We do general liability here at Prosper. And then it's very simple. The ramifications of insuring a 2-unit condo incorrectly, it's very simple, is any type of claim could be denied if a claim is filed and then they go to take a look at the policy and it's written incorrectly. They can deny that claim. Alternatively, they could pay the claim and then non-renew the policy when it comes around to renewal. So 2 possible repercussions of that is claim being denied and cancellation or non-renewal of the policy, potentially both as well. So it's very important to work with an insurance company that knows how to read the condo docs and understands exactly the type of insurance that is needed in order to protect them and make sure that their claims are paid out if they are to have one, or they don't risk cancellation or non-renewal. All right, so now we're moving outside of the condo unit realm and moving into landlord insurance. Out of those of us on the phone, any landlords on here? No? Okay. So we're going to talk about the difference between a homeowner's policy and a landlord policy. And landlord insurance provides coverage for property owners renting out 1 or more residential homes, apartments, or condos. So they're not living in that property. They are renting it out to, another person who is residing in that home or condo or apartment. The premises, it includes premises liability. The tenant's property is not covered, and it's written on what is called a DP3 form. So this is what is covered under a landlord insurance policy. So property damage due to fire, storm, theft, vandalism, and even tenant damage. It includes liability insurance for the landlord, and it protects you against any type of liability claims and or lawsuits, whether it's a tenant that's currently living in your rental, a visitor of the tenant, or even a trespasser. If a trespasser is injured on like your property where your rental is, you could find yourself in a legal situation. It's really crazy, but it's true. Like if someone is like trying to, break into your home and they trip and fall down the stairs, they could sue you for that. So that's where liability coverage comes in. Loss of your income is included in the landlord policy. So this will help compensate you for lost income in the event that a rental property becomes uninhabitable due to a covered loss, such as a fire or a storm. So let's say that your tenant experiences a fire in the kitchen, and while the kitchen is being renovated, they have to, go stay with someone else or stay in a hotel. They're not paying you rent, but that's income that you would be getting from that tenant. So you have coverage. It's also known as rental reimbursement that will prevent you from losing income that you could have collected in rent. And again, this is included in all landlord insurance policies. And as far as the DP3 form, that's how landlord insurance is written. Like I said a moment ago, the condo association is written as an HO6. A DP3 is considered landlord policy, and it's important to insure this rental property correctly by writing it on a DP3 and not a regular homeowner's insurance policy. Again, because any type of claim that is filed, if it is written incorrectly could be denied, and the policy could be canceled or non-renewed, just like before. So some stuff that the landlord policy doesn't cover, how it makes it different, is it's not going to provide, personal property coverage for the tenant living in residing in the dwelling. Like they would be responsible for getting their own renter's insurance policy to protect their belongings. Any questions about that? Okay. All right. So renovation insurance, which is also known as builder's risk insurance. It is a specialized type of property insurance that helps protect buildings that are under construction. So builder's risk insurance helps protect construction projects from property damage that's due to fire, lightning, hail, explosions, theft, and vandalism. So if you're planning to renovate or build an addition on an existing structure, you should let your insurance company know that first before you start to do it. Because what's going to happen is they're going to double check to make sure that you are appropriately covered throughout the process. And your insurance company or your insurance needs will vary depending on the scope of the remodel and whether or not the residence is occupied throughout the project. Many insurance companies do offer home under construction endorsements that they can add to the policy instead of like having to get a new policy, such as the builder's risk policy. But again, that's something that you would need to speak with your insurance company about prior to starting the projects, because if you don't do that and you start the process of adding an addition or doing some major renovations, and you experience a claim, there is grounds for denial of that claim. And like I said, you always want to make sure that you are appropriately covered. And the difference in coverage versus normal homeowners insurance, like again, this is just going to provide coverage for like the lightning, hail, explosion, theft, and damage or vandalism. It's not going to cover like personal property or anything like that. It's just the building that's like undergoing the renovation and the renovations that are happening. And if a client has a mortgage on a renovation policy, that, let's say that someone is purchasing a property that they plan to completely renovate. First of all, we need to find out from the lender what type of policy they are requiring the client to have, like going to closing. Typically, the policy needs to be written on an annual basis. But if it's going to be undergoing a lot of renovations and the buyers are not going to be living in the home, then an insurance company is not going to write a regular homeowner's policy on that. They're just not going to do it. They're going to want to write a builder's risk insurance policy or a renovation insurance policy. And the lenders will typically accept that, but it must be written on an annual basis. A problem you can run into with that is the premiums are usually higher because they're at, a higher risk and more susceptible to damage. But typically what happens is we will write that policy for a full year. Let's say the renovation is only slated to, take 6 months. Well, once the renovations are complete, they can cancel that builder's risk policy and be refunded any unused premium, usually less some taxes and service fees, and then put a regular homeowner's insurance policy into place, and that will satisfy the mortgage as well. So it's always good to have an open line of communication. If your buyer is going to be renovating a home and not living in it, always let your insurance agent know so that they make sure they are putting the correct insurance policy on that property. And the last thing we're going to talk about is vacant property and vacant land insurance. So unoccupied and vacant homes, as I just mentioned, present a greater insurance risk than homes that are occupied for many reasons, including slower emergency response times and the increased probability of a break-in occurring because they're sitting there vacant. No one is there to, keep folks who maybe want to break in away. So vacant property insurance is designed to provide protection from damage or loss of the home that is uninhabited. Typical homeowners insurance policies will not cover fire, vandalism, liability, or other types of claims on a vacant property. If a home has been sitting vacant, typically for more than 30 days, then the insurance company is going to want to write a vacant property insurance policy on that home and not like a regular homeowner's insurance policy. So if you leave your home for a few months and there is a fire, vacant home insurance would provide coverage where your standard homeowner's insurance policy would not. So if there's some instance where you're going to be away from your home, out of the country, for more than a month, you're going to want to contact your insurance company and put a vacant policy in place so that your home is covered in the event that while you're gone, you have protection. A separate policy can be purchased, or depending on the carrier, an endorsement can be added to your homeowner's insurance policy as like vacant home protection if you are going to be gone, for a certain amount of times. If it's purchased as a separate policy, you'll no longer need your standard homeowner's insurance policy. So you don't need to have two concurrent policies. It's one or the other, or a homeowner's insurance policy with an endorsement added to include vacant property protection. Again, it just depends, insurance carrier to carrier. And then as far as vacant land insurance, it's basically just a form of liability insurance. It exists to protect you in case anyone gets hurt on your vacant property. So meaning it will cover their medical losses as well as your legal fees. So you're not legally required to have vacant land insurance. No one's telling you you need to, but anything that protects you and your investment from litigation or medical expenses is always a good idea.
So,
Go ahead. Yes.
so would it cover like vandalism or anything like that? Or just,
So I was just going to say what it does cover is pain and suffering of, whomever was injured on the property, medical bills, lost wages, legal costs, and death. It is not going to protect you against vandalism. It's just liability insurance for someone who is on your property that could get hurt. It does not financially protect you against any injuries that were purposely inflicted. Or if a person suffers injuries while working for you, and it doesn't protect anyone in your immediate family either. So like you, your spouse, or dependents. It's strictly someone outside of your family who is on your land and they get hurt. So it does not protect against vandalism, unfortunately. It's just to cover medical bills and lost wages if someone, can't work because of an injury on your property. Any questions about that? Nope. And that was the end of it, you guys. Any questions? I hope you learned a little bit.
I just have one question, and sorry, my phone kept cutting out when you were talking about the landlord insurance.
Okay.
So I have long-term tenants right now, but I will be converting it from like long-term tenants to short-term rental. Is there a different insurance once you do the short-term rental? Okay.
Yes, you would definitely want to let your insurance company know, because some insurance companies won't do short-term rentals. They're at higher risk for damage. So it's always good to check with your insurance company. I will tell you that at Prosper, we do short-term rentals if you're interested in talking to anyone here.
All right, awesome. Thank you.
Any other questions? No? Okay. Noelle, because you turned on your camera, you are eligible for a CE course. So I will send you an email with the CE enrollment form. It's going to come from DocuSign. Can I get your email address?
Yeah, do you want me to type it in the
That
chat?
would be fantastic. Yes, and I'll get that before. Mike, you have a question. I saw.
No, I just made a comment about how levels of insurance are necessary. Family member in Georgia had someone actually burn their house, set their house on fire, trying to harm the tenant. And she didn't have it properly insured, and that house was destroyed, and the property next to it that she owned was severely damaged by the fire, and it's all on her because it's not covered.
Oh my gosh.
Yeah, thankfully the person inside didn't get hurt, but everything, she was just about to sell that to somebody, and now she's left with nothing. And the money she had, the city's on her for, removing the burnt structure and all that. So
yeah,
insurance is necessary, and they don't know who did it. So
having the right type of insurance, right? And making sure that you're communicating exactly what your plans are for that property, so that in these, cases, they're covered and they're not having to foot the bill for several $1,000s, I'm sure.
yeah, thank God the property was paid for, but she still has all those other expenses. So it's
Exactly.
messing around with insurance is not something you want to do.
No, not at all. Well, thank you guys so much for being here today, and I look forward to seeing you next month.
Thank you.
All right, bye, guys.
I sent you my email too.
Oh, I got it. I
All right.
copied and pasted it. So I'll be sending that to you later this afternoon.
Thank you.
Thank you. Bye.